Good morning and welcome to the I3 webinar on European private credit, co-hosted with Pemberton Asset Management. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. So today we'll be discussing European private credit with special attention for the subsector of direct lending. We'll do this at the hand of a study by the Oxford Saïd Business School, which was conducted supported by Pemberton's proprietary research. Now, we would like to make this webinar as interactive as we can, so if you have questions, please feel free to put them in the question box and we'll address them as we go along. As a disclosure, we have to mention that this webinar is for educational purposes only, does not constitute financial advice. It is intended for institutional and wholesale clients only. So our guest today is Symon Drake-Brockman, who is the co-founder and managing partner of Pemberton Asset Management. Prior to co-founding Pemberton, Symon worked at RBS, where he was global head of debt markets with responsibility for trading, sales, research, origination across leverage finance, high yield, capital markets, and loan syndication. Now, Symon is based in London, but he's actually one of us. He's an Australian, grew up in Western Australia and went to the University of Western Australia. But at the moment, he's located in Dubai. So we are very thankful to Symon to join us in this early hour. Symon, welcome to the webinar.
Thanks very much. Thanks for having me this morning.
All right, well, let's get straight into it. So at I3, we've covered Australian private credit and US private credit before, but European private credit has its own characteristics. And I believe there's also still some misconceptions around European private credit. Can you maybe talk us a little bit through these misconceptions and perhaps how it compares to some of the other private credit markets?
Very happy to. I suppose if you look at private credit in Europe, it started about a decade ago after the GFC, and I think the United States, the foundations of private credit really came after the Resolution Trust and the downturn in the US economy in the early 90s, which led to the evolution of a whole series of specialized financing companies in the early 90s, and then by the late 90s, it moved into the credit markets as the regional banks in the United States were starting to be consolidated by the big players like Bank of America, JP Morgan, etc. And so the industry in the United States has been going for over 2 decades. But when you come into Europe, the industry was an outcome of the GFC and a movement which was driven more by regulation in Europe, where under Basel III, which was introduced around the time that we went into the financial crisis, banks were encouraged not to hold non-investment grade risk by the capital weightings that banks had against that risk in their balance sheet. And it was at a time when the ECB in Europe was really trying to downsize the banking system, which had grown to be around 300% of GDP. And so the central bank's movement to try to bring banks down by forcing up capital ratios to around 12–14%, and the introduction of Basel III into the marketplace, which encouraged banks to hold investment grade risk rather than non-investment grade risk, really saw the European market make a significant shift for the financing of non-investment grade mid-market companies, and particularly mid-market buyouts, which were being done by private equity. And so as this past decades evolved, you've seen institutional investors in Europe come into the market, and now the European market, you're probably about 40% of the financing in this particular part of the market is now coming through institutional funds like ourselves, which have built large platforms across Europe. The other thing that's quite different in Europe to the United States is just the number of managers operating within the marketplace. So, if you look at the US today, there's probably about 250 different funds in the US market operating in all different sectors of that marketplace. In Europe, you've probably got somewhere more like 90 to 100 managers operating, But the top 10 managers in Europe are accounting for about 60%, maybe even as high as 65% of the activity level that's going on in the European market. And the top 3 managers, which we see ourselves as one of those, is doing about 35 to 40% of the market volume in that space. So you have a much more, I would say, consolidated market in Europe. And that's pretty much the same as what we had in the banking market. So when I was at RBS, we had the largest leveraged finance platform in Europe. We had about 20% market share in the European marketplace for a decade. And the top 10 banks controlled about 2/3 of the activity level that was going on in the marketplace. And that's now just been transferred into the institutional fund market, where the top 10 managers have about 65%.
Yeah, so it's a much more consolidated market. But I think we also had some misconceptions around the European market around the complexity of the different legal systems. And I think there's some headway made in recent years. Can you tell us a little bit about that?
Yeah, I think, historically, I suppose, Europe is a market which has had a single currency for 2 decades. So the euro came in 1999, and that created the capital markets initially on a pan-European basis, and is now, if you look at it from a direct lending point of view, a pan-European market as well. What happened after 2010 was the European Union introduced what they call the capital market regime, which was effectively a movement by the EU to bring much greater standardization as far as creditor protection in the European marketplace. And so historically, I think investors felt that there was tremendous differences between the likes of the UK and, for example, Spain or Italy, as far as creditor protection. And those two, particularly the Southern European economies, have seen massive change in the bankruptcy laws in that part of the world. So Spain went through a very radical restructuring of their bankruptcy laws, and it now looks rather similar to the UK. So historically, small creditors could hold out a rather large restructuring and therefore be quite mischievous in bringing a solution to the company's financial problems. This was tested in Abago, which was a large restructuring that was done in Spain about 5 years ago. And when it went through the court system, the minority investors were unable to prevent the restructuring, which had been agreed by the larger investors inside the process. And so the holdout mechanism, which had been quite difficult in Spain for a number of restructurings, no longer applied. I think if you come to Italy, the challenge in Italy was less around the actual investors or the lenders creating problems, but it was the court system. And Italy had a very, very convoluted structure in their court system, which meant as a lender, it could take you up to 5 or 6 years to actually get a judgment, which is why most transactions were documented under English law so that the lenders could take it through the English court system much more quickly. And when Renzi was prime minister, to try to enhance the restructuring of the banking system, he brought in specialized bankruptcy courts. And that has now moved the process into as short as 3 months in taking it through the system. And what you've seen is a number of NPL players move into the Italian market, which is, I think, a strong sign of confidence that the legal system now protects lenders and gives the ability to move through the restructuring process very, very quickly. So I think if you look at Europe today, you're operating in a very, very similar position in nearly all the countries, with very minor nuances in each one of them. And we actually did a paper with Latham & Watkins, the law firm, which was attached to the Oxford report, which actually talked about how Europe had become much more standardized as a restructuring and creditor protection process. And so it looks pretty similar to the United States these days.
Yeah. So can you give us a bit of a sense of the growth of the market, because it has grown quite rapidly. Where is it now in its maturity versus the US, for example?
I think Europe is, if you look at growth, the statistics tell you different things, but I think if you look at the percentage of financing that's done by institutional investors like ourselves, we're probably about 40% of the market today, up from 10% when I established the firm in 2012. And in a number of markets, we're about 50% of the financing that's been done in those particular jurisdictions. If you look at the United States, the numbers that come out show about 85% of the market is done by institutional platforms like ourselves. And so, Europe is still in the evolutionary stage of moving from, I would say, banking to non-banking lenders in that space. But I think, the pace of that has increased tremendously because the pace of M&A in Europe has really, really changed over the last 5 years. And what I point out to people is that Europe is in the very, very early stages of sector consolidation. And, we had a very complicated market up until 99 with, Deutschmarks, French francs, Italian liras. And so if you were a corporate, it was quite difficult, particularly in the mid-market, to build operations in multiple countries because you had massive currency risk between the different jurisdictions. And with the introduction of a single currency, that obviously became a lot easier. But the initial phase was really from, I would say, 2000 through to 2010, was a massive growth in capital markets, with institutions flooding into euros to borrow money so they didn't have currency risk in their own balance sheets. And since 2010, what you've started to see is a movement of private equity and other private companies into buying businesses in the mid-markets and starting sector consolidation. And so, private equity is sitting on 300 billion of dry powder. Volumes inside of Europe of transactions happening with private equity firms is at an all-time record. And you're sitting in a demographic where business owners, when the euro was created, who were in their 40s, are now in their 60s. And you have a demographics of business owners who are looking to potentially sell their businesses now in very attractive sectors which need massive consolidation on a pan-European basis. So although we're 40% of the market is probably going to double in size over the next 5 years. And you're also going to see the percentage of the market that we control go from 40% to 60%. So there's huge growth opportunities for lenders like ourselves in the European market.
Yeah. So with this growth happening, we of course have seen in the last sort of 18 months to 2 years that there's this massive pandemic that suddenly influenced the world. How has it affected your sector? Has it stalled the growth, or what is going on?
Yeah, I mean, clearly COVID has been, I suppose, in one sense for the European direct lending market, a real test of how successful the industry has evolved over the past decade. And I think when I was setting up the business, one of the things that a lot of investors outside of Europe used to say to me was, but Europe's never been tested, because the direct lenders went through the GFC, and therefore there was an ability for institutions to look at how the market performed and how individual managers performed. And now Europe has definitely been tested. We've had, I don't think when I was ever writing a credit paper, I was ever going to put a scenario with government enforced lockdowns with people having to stay at home for months at a time. And so you've seen, industries go through, pretty monumental changes. And I think it's been a positive for the direct lending market because the market has come through this incredibly well. I think there are differences between managers, and investors that I talk to, I think now have seen the performance of some managers have been stronger than others. But I think fundamentally, as an asset class, the asset class has come through the crisis incredibly well. And I think one of my big observations, which I would say, is that at the peak of the industry in 2006, 2007, we were underwriting deals with equity contributions of 25, 30%. What the industry did, over the last decade is be very disciplined about private equity putting in 50 or even 50+% equity in transactions. And I think those large equity buffers really made sure that in the downturn, companies were in a strong financial position, and with good management, they were able to be quite, quick to respond in conserving cash and making sure that the business was well, positioned to go through the downturns in that space. So I think, and the other key thing is, I think we're financing different sectors today. Historically, we were heavily focused in areas like manufacturing, retail, pre-2010. If I look at the last 20 months, we've done about 6.5 billion euros, but it's been in healthcare, it's been in outsourced business services, it's been in food, it's been in e-commerce, and these are all growth parts of the economy rather than, I would say, some of the old economy, which suffered much more through the pandemic.
Yeah. So that risk that you mentioned, that Europe had never been tested, that was actually one of the risks that was mentioned in this Oxford Saïd Business School research, which at that time obviously hadn't happened then yet. But maybe we can delve a little bit more into that study. What was sort of the reason for the study to be conducted, and how did you team up with the business school?
Well, I suppose, there hadn't been an academic study published by any of the leading institutions in Europe really looking at what were the key drivers that were enabling institutional investors to come into the marketplace, and what was the performance of private markets versus public markets in that space. So we had the opportunity, because we'd done work previously with Oxford, and in talking to the professors there, they reached out to us and said that they were very keen to put an academic paper together looking at the marketplace, so that they could share that with the institutional market globally as part of the development of the business school. And so we thought it was a great idea. They knew us very well from our previous role at running the business at RBS, and we put a team together to bring together the data and to help them in the academic study with their PhDs at the business school.
Yeah, so this study focuses particularly on the subsector of direct lending, which in recent years have become one of the dominant sub-strategies within the private credit space. Why is this area has become so popular?
Well, I think they were particularly interested in looking at this whole concept of banks and this movement of activity out of the banking market, and was it a temporary move? Was it a permanent move? What were the risks? And if there were downturns, what were the recovery rates looking like at this particular asset class for investors in that space? And I think certainly, I mean, Europe is a part of the world with a lot of banks in that process. So I think that was always particularly interesting to investors to understand the concept of the European banking landscape, and really was this a structural change that was going to be permanent and create opportunity for institutions to come in and look for attractive yields and returns in that space. And that was the genesis of why we got together.
Yeah. Were there any surprises for you in the findings of the study, or any key takeaways?
I think the key takeaway that they touched on was certainly that this was a structural change in the European banking system, and that's been subsequently reinforced by Christine Lagarde and the president of the ECB, who has even recently made statements around much more bank consolidation inside of Europe. And my own experience in the banking world is when you put two banks together, you end up with one bank's balance sheet. And so you lose a huge amount of capacity coming out of the market through these mergers. And if you look at a country like Spain, where they used to have 70 savings banks, which is now being consolidated down to 6, that's been a very dramatic change in the landscape of banking. And you're starting to see that in Italy now. And the market, which is most behind, is probably Germany, but the German banking industry was one of the worst affected in the GFC. And you see the ongoing problems at Deutsche Bank and Commerzbank and the Landesbanks inside of Germany. So the conclusion was that this was a substantial structural change. Basel III had really reinforced it. And as we go into Basel IV, which will come out in 2 years' time, that banks were going to further contract away from this part of the market, opening up the opportunity. The second part was their assessment of the size of the growth of the market. And in the paper, they talk about the market growing by at least 50%. And that, in their mind, was just the changes in the banking market. It was not factoring in any M&A growth opportunity that we are seeing in the European markets. And then they also did a piece of the study looking at recovery rates. And I think their conclusion was that, the recovery rates in private markets were more attractive than public markets. And that therefore, investors were being well rewarded in not only a pickup in yield, but also, better downside protection if there were difficulties in the marketplace.
Yeah, so the direct lending space is partly linked to private equity activity as well, as part of buyouts or simply an increase in leverage. Has this relationship changed over the years, and what's sort of your expectation going forward?
Yeah, I mean, I think in Europe, two things. I touched on the first one where, my biggest observation is just the amount of equity that private equity firms are now putting into deals. And, interestingly, we did a deal recently in the healthcare sector where the private equity firm paid effectively about 16 times EBITDA for the company, yet the financing that we did was at 5 times. And so, they put in 11 times of equity, so nearly, just over twice as much equity to our debt in that process. So what you weren't seeing is a stretching of the multiples as a lender. You were seeing the stretching of the multiples through the equity buffers that were going into these deals. And that obviously gives tremendous protection on the downside if, as we go forward, we have any economic downturns in the marketplace. The second part is, which has been quite different in Europe, is covenant protection is still available in the European marketplace. And, when we go back to the, straight after the GFC, we were probably getting 3 covenants inside, all the deals that we were doing. Today, we get 1, sometimes 2 in that process. The most common being, the actual leverage covenant inside transactions. But that is a very, very big difference, to the US market, which has effectively gone to covenant light. And the challenge when you're in covenant light is you don't have the ability to really intervene because there is no trigger in the documentations. And we saw it through COVID that the European marketplace, by having covenants inside all of the documentations, were able to go to private equity pretty early on and say, we're heading to a covenant breach. Let's sit down together. Let's work out what needs to be done. And I think that was very positive because private equity responded really well. We understood that this was, hopefully a transient situation, but none of us knew whether it was going to be 1 year or 2 years. And therefore, we started working together in helping the companies through the process. And we had I think 4 or 5 companies in our portfolio where private equity just injected equity straight away to make sure that there was plenty of liquidity inside the businesses.
Yeah. Now, the study also made some comments around, or observations around, dry powder, which was sharply decreasing when this study was done. Now, I think most of these numbers are just sort of touching at the start of the pandemic. Do you have a sense of what the dry powder is at the moment and how this sort of affect the demand for European private credit?
Yeah, I think, I mean, it's interesting. If you look at pre-Quinn studies on dry powder, about 30% dry powder in the direct lending market. But that is a relatively small amount compared to the amount of dry powder sitting in the private equity hands. And I think, the reason we went from, as the study showed, 60% dry powder down to 30% dry powder in the marketplace over, a very short period of time was really going back to this growth in M&A activity and the slowdown of the banks, which meant that we were able to put the capital to work quite quickly and consistently. And it's interesting, if I look at volumes, we were, if you look at volumes in 2019, the market was extremely strong. We went into 2020 with a very, very, very active Q1. And then obviously by late Q1, COVID was starting to roll through Europe. And so activity really came to a halt in Q2 of 2020. And then gradually we started to see, as we got into Q3, a pickup again, and then by Q4 we were back to near pre-COVID levels in business volumes in the European marketplace. The really interesting part of it, if I look at 2021, as a lender in Europe, our volumes, and we compare to 19 and not 20, are up 50% from 2019. And so you've had a huge pickup of M&A activity in the European marketplace, and that's in all the countries, and it's been consistent across the board and in that space. And we think that M&A activity is going to stay the same, because one of the things that came out of COVID is you had owners of businesses who in Q2 last year all of a sudden saw the value of their businesses fall by 40 or 50%. And if you're an owner and you're 60 and this has been your life's work, that's a pretty big shock to happen all of a sudden as you're heading towards retirement. And then obviously the businesses bounced back in Q4. And I think that really opened up the eyes of a lot of owners to think, well, actually, maybe I will have discussions with private equity. Maybe I will think about the opportunities there. You also had management teams who saw, young management teams who also saw the opportunity to go to private equity and say, we see a huge opportunity to roll up different platforms across Europe to make a pan-European champion. Would you like to be a partner with us in the business? And therefore, this kind of demographic in Europe of mid-market companies really embracing private equity was something we didn't have a decade ago in Europe. And it's been in the United States for decades, but is a relatively new phenomenon inside of Europe. And so we think, once again, the benefit in the European marketplace is the ability to put this capital to work, which is why dry powder is very modest in the European market compared to the US market. Yeah.
Now, apart from having had a pandemic happening, we're also in an unusual situation where we have extremely low interest rates. And so this has sparked this search for yield. And the Oxford Saïd study touches a bit upon this, where they don't quite make predictions, but they give a few possibilities around how this might play out. And I actually think that the central bank stimulus programs might actually help the demand for private credit. Can you explain a bit what their train of thought is there?
Yeah, well, I think we've lived through a fairly extraordinary decade since the global financial crisis, where interest rates globally have come to record lows, And although we've seen a modest increase over the last few months, these are still at relatively low levels compared to historic through the history of different markets. And I think particularly in Europe, the ECB has already quite differently to the United States signaled that they think rates in Europe are not going to move very much, if at all, over the next year or two. And obviously, the world is concerned around inflation, and the world is concerned around supply chains at this point of time. And I think that the US economy is a very consumer-driven economy, and they have significant labor shortages in the United States at the moment, and they have quite considerable wage inflation because of that coming into the US market. Plus, you've got other factors around housing prices and supply chains, etc. You don't have quite those same demographics in the European marketplace. So, yes, supply chains have been disrupted. Yes, we have energy price inflation coming into the market, but those, tend to appear to be at this point in time to be much more transitory. And so we'll adjust to a new higher level for energy prices. We expect supply chains to become more freed up by the middle of next year, in talking to a number of the companies that we're involved in. And so, Europe is sitting in a situation where you don't have the same labor market pressures that you do in the United States in that process. And I think if you go back to that, the stimulus programs that the central banks have put in Europe has obviously led to a lot of institutions moving out of public markets and into private markets in that search for yield. And we think, we live in a situation in Europe where 10-year German government bonds were at minus 70 basis points. Today they're minus 12 basis points, but they're still minus. And so therefore, even if we get back to positive, it's going to be positive 25 basis points. We're not going back to 4% or 5% where they were in the early 2000s. And I think that the study highlights that, for investors to meet their liabilities, private credit is going to be a key source of their asset allocation programs because of the yield pickups that they can get in the private markets.
Yeah. Now, just a quick reminder to our attendees that we do have the opportunity to ask questions, so feel free to put some in the question box. And while you gather your thought, we might move away from the direct lending space to what are some of the other opportunities within the private credit sector. And one of the ones that you raised is the working capital finance area. Can you tell us a little bit about what the opportunities are there?
Yeah, so we within our firm, set up a working capital finance business, which is which is focusing on providing short-term financing for much more of inventory and other movement of goods inside of companies. And once again, this is a huge area where banks used to be extremely active inside of Europe and on a global basis. But once again, we've been seeing gradually the banks drifting back from that space, primarily because of liquidity ratios inside of their balance sheets. And so, for example, we recently did a deal in Europe where we were working with one of the largest French grocery chains, and they obviously have huge amounts of goods that they're moving across their different outlets and distributors in their balance sheet. And so they used to have a large facility with one of the European banks, but they needed to grow that facility, and the banking market just wasn't having the capacity to grow with them in that space. So they came to us, and we provided that facility. And the attractiveness is that, for institutional investors is, these are 30-day, 60-day, 90-day financing of inventory moving across the balance sheet of these companies. And therefore, investors are able to bring capital into this part of the market as an alternative to either money markets or to fixed income, where they can pick up, on a investment grade basis, LIBOR plus 125 basis points. For a non-investment grade crossover type credit, probably LIBOR plus 300 basis points. But this is, a huge pickup to money markets and short-term fixed income, but you're still keeping the liquidity that you need potentially inside your portfolio, because it's a monthly redemption product that we run inside of the business. And we see that as complementary to what we're doing on the term lending side, because we're analyzing businesses and companies which are the same across our portfolio. We're just looking at the short end of their balance sheet versus the long-term financing that they do inside their balance sheet.
Yeah, so we actually got a question here from the audience. What level of spreads are available in the private lending market?
So we've looked at the market slightly differently than our peer group. So we've set up 3 different strategies, all in the direct lending space. And so we have what we call our traditional mid-market unitranche lending, where we're averaging a spread of probably around 6.5% to 7%, and then we're getting paid 3 points up front, which is the standard fee that we get in the European marketplace. So you're looking on a 3-year basis of around 7.5% to 8%, and we're achieving IRRs of around 8.5% in that portfolio. We then set up what we call our strategic credit fund, which looks at slightly more complex first lien opportunities. It does second lien, mezzanine type financing as well. And that fund is achieving a IRR of around 15% in euros. And on first lien, we're getting around 9 to 10. On second lien, we're getting around 10 to 12. And on mezzanine, we're getting around 14, 15%. And then recently, 18 months ago, we set up what we call our senior loan fund. And that's targeting a different part of the market. It's really looking at bigger companies, double B type credits versus the single B in the mid-market and strategic credit. And that's achieving around 6% in euros for double B corporate. So a spread of about 300 plus over high yield double B corporates in the European marketplace. And so the idea from our perspective is investors have 3 different distinct pools that they can look at. The double B 6%, the single B 8.5%, and those 2 are senior funds, or our strategic credit fund, which looks all the way through the capital structure, and that's achieving 15%. So it really is designed for institutional investors to choose their risk profile, and then we put the portfolios together.
Yeah. Now we only got a minute left or so. Perhaps we can finish up with, do you have a favorite deal in the last sort of 12 to 18 months?
Yeah, definitely. So we did a deal for Advent. Actually, they came to us in April last year, just as COVID had really hit. So equity markets were down around 30 or 40% at that stage. And they were interested in buying the second largest parcel delivery company in the United Kingdom, called Hermes. And at the time, they reached out to us, and a number of institutions were closed because of what was going on in the market, and they came to us and said, would you be interested? And we were in a fortunate position. We'd already done a complete review of our portfolio at the end of February, so we were very comfortable where we were with our 100 different investments. And so we ended up doing the work with them to buy the deal, which was a spin out from a German conglomerate. They were competing with FedEx for the deal, so it was hotly contested between Advent and FedEx for this business. And fortunately, they won the deal. and we provided the financing for them. And at the time, when we did the deal, the company had an EBITDA of about 50 million. Today, it's currently running on an EBITDA of 210 million, and it went from about 50 to 120 on increase in parcel deliveries, but it went from 120 to 210 on efficiencies that Advent brought into the business.
Right.
And so it was, a fantastic deal, but it was also fantastic to see how they've operated the business and how they've really streamlined it and made it a much, much better business than when it was owned by the conglomerate.
Yeah, for sure, for sure. Well, Symon, thank you very much for this, and thanks for your time at these early hours. It's much appreciated. To our attendees, I hope this was useful, and hopefully we'll see you the next time again. Thank you very much. Have a good day.
Thanks very much.